Welcome to the debate. Today we're diving deep into some truly monumental shifts in India's goods and services tax, or GST system. Specifically, we're dissecting the decisions that came out of the 56th GST Council meeting in New Delhi on September 3, 2025. That meeting saw a dramatic reduction in the number of tax slabs, primarily consolidating most goods and services into just two rates, 5% and 18%. Of course, luxury and what are termed sin items still carry a special higher 40% rate. These significant changes, which went into effect on September 22nd, aligning with the auspicious start of Navratri, are intended to simplify economic transactions and stimulate growth across the nation. They've certainly sparked considerable discussion, and, rightfully so. The central question guiding our discussion today is this.
Do these recent 2025 GST slab rationalizations truly represent a natural, collaborative evolution of what was already a fundamentally sound tax system, or are they more a belated yet undeniably necessary rectification of an initially problematic, perhaps even politically influenced design that caused widespread issues? My perspective is that these changes stand as a testament to the system's dynamic evolution and the deeply collaborative spirit embedded within India's federal structure, showcasing a continuous, evidence-based refinement of a long-sought economic reform.
And I will contend that while these 2025 adjustments might appear beneficial on the surface, they primarily serve to underscore the initial flaws and inherent complexities that plagued India's GST rollout from day one. I see them less as an organic progression and more as a corrective measure, addressing fundamental issues that were present right from its inception.
Right. So to truly understand where we are today, we really need to appreciate the journey. The recent 2025 GST slab rationalization isn't some sudden reactive pivot. It's the latest chapter in a multi-decade national ambition. The very idea of a unified tax for India goes back a long way. Think about VP Singh's modified value-added tax, or MODVAT, introduced way back in 1986 under Rajiv Gandhi. MODVAT was, one of the earliest attempts to streamline indirect taxes at the manufacturing stage, trying to avoid that cascading effect of taxes. That vision then evolved through Atal Bihari Vajpayee's committee in 2000, which further explored a comprehensive national GST, and later the Congress-led UPA government's legislative efforts in 2011 to finally bring it to fruition. This extensive historical context, stretching across different political leaderships, clearly demonstrates that GST was never conceived as a purely partisan concept. It was a shared national vision, a one nation, one tax dream. The original launch by Arun Jaitley on July 1, 2017, despite facing its initial challenges, and yes, there were challenges, was a foundational achievement. It successfully unified India into a single market, something countless businesses had longed for. It eliminated over 17 distinct central and state-level indirect taxes, sweeping away a labyrinth of levies like excise duty, service tax, VAT, and those frustrating interstate barriers which previously made moving goods across state lines a logistical nightmare of paperwork and delays. This alone was transformative. Crucially, the initial multiple slabs, the 0, 5%, 12%, 18%, and 28% plus cess, were not unilaterally imposed by the central government. They emerged from an empowered committee of state finance ministers, notably including representatives from opposition-ruled states at the time. This structure was designed to build consensus, ensuring that states, regardless of their political alignment, had a direct say in shaping the new tax regime. Therefore, these 2025 changes, far from being an admission of initial failure, are a natural, informed progression. They are the cumulative result of years of careful tweaks, data analysis, and lessons learned from real-world implementation. This culminated in a unanimous decision at the 56th GST Council meeting, involving all 31 states and union territories, and chaired by Union Finance Minister Nirmala Sitharaman. This deep collaborative history and the system's inherent capacity for iterative improvement are, in my view, undeniable. We've seen concrete economic benefits already. Truck travel times, for example, dropped by a significant 20% on national highways because checkpoints vanished, and overall logistics costs decreased. Gross collections hit a record 22.08 lakh crore. That's roughly 2.2 trillion Indian rupees, or approximately 265 billion USD in 2024-25, showcasing the system's growing efficiency and compliance. Even the average GST rate dipped from 15.3% in 2017 to 9.8% by 2025, demonstrating the system's self-correcting strength. These 2025 changes are a proactive strategic shield against global economic headwinds, explicitly designed to strengthen domestic consumption and provide much-needed clarity for businesses.
While I certainly acknowledge the long-standing aspiration for a unified tax system in India and the intellectual lineage you've traced, we cannot, in good conscience, ignore the tumultuous and often chaotic reality of its initial launch on July 1, 2017. The historical context you describe is important, sure, but the lived experience for many businesses, particularly small and medium-sized enterprises, MSMEs, was one of significant scrambling. Their existing accounting systems were suddenly obsolete, they faced steep learning curves, and the official online portals for filing returns often crashed under the sheer weight of traffic. It was quite a mess. This led to delayed refunds for many, tying up critical working capital and causing widespread discontent. Critics, including prominent opposition leaders, didn't just casually object. They dubbed it the Gabbar Singh tax, referencing a villain known for his arbitrary demands, and called it a big failure that devastated small businesses. This initial disruption points squarely not to mere teething troubles, but to inherent complexities, and I would argue, an insufficiently prepared rollout. The very necessity to slash tax slabs from the initial 4 main rates, excluding 0% and cess items, down to just 2 in 2025, after nearly 8 years of operation, strongly suggests that the initial multi-slab structure was overly complex and burdensome. This rationalization, while undoubtedly welcome, implicitly validates those earlier criticisms. It's a tacit admission that the system was, in its original form, unwieldy. Mallikarjun's observation of one nation, 9 taxes captured this perfectly, highlighting not just the multiple slabs, but the numerous exemptions, special rates for specific goods, like gems or gold, and the compensation cess, all of which added layers of complexity that contradicted the one nation, one tax ideal. The argument that initial slabs were decided by a committee including opposition states, while true, doesn't negate the fact that the outcome, the actual implementation and the burden it placed on taxpayers, was exceedingly difficult for many to navigate. The current reforms, as P. Chidambaram astutely noted, are welcome but 8 years too late, which powerfully indicates a belated acknowledgement of significant structural issues rather than simply a natural evolution. Furthermore, concerns about the GST Council's autonomy have always lingered beneath the surface. The Prime Minister's public hint at these next-generation reforms on Independence Day, August 15, 2025, preceding the Council meeting itself, raises legitimate questions about the truly collaborative nature of the decision-making process. As Jairam Ramesh suggested, such preemptive announcements could make the Council's deliberations feel like a mere formality, rather than a truly independent forum for states. While gross collections have certainly risen, genuine worries about states' revenue dips persist. The impending end of the compensation cess, a special levy collected on specific goods like luxury items and tobacco, specifically designed to compensate states for any revenue shortfalls they experienced after transitioning to GST by March 2026, adds significant fiscal pressure. This is especially true for debt-burdened states like Punjab or Jharkhand, which might struggle without these crucial funds. The reform, while positive in many respects, is not without its lingering flaws and unaddressed concerns. The continued existence of special rates, such as 0.25% for gems and 3% for gold, further complicates the one nation, one tax ideal, reminding us that simplification is still an ongoing process.
I see why you might frame these 2025 changes as a rectification of a flawed design, given the initial challenges you've highlighted. However, I'd suggest we look at this through a different lens, one of intelligent evolution rather than a forced admission of failure. Any system of this colossal scale, designed to unify an economy as diverse and complex as India's, inevitably requires iterative refinement based on real-world data and feedback. To expect perfection from day one in such an undertaking is, I believe, unrealistic. The unanimous decision of the 56th GST Council meeting, a marathon session involving all states and union territories, serves as powerful evidence of this collaborative, adaptive nature. It speaks to a collective national will to improve, not a reluctant capitulation to past mistakes. The system's design explicitly accounts for such adjustments, as we've seen with fixes like the inverted duty structure, where the tax on raw materials is higher than the tax on the finished product, creating a credit accumulation issue for businesses. Resolving this, for example, through targeted refunds, directly frees up crucial working capital for manufacturers. This isn't penance, it's a dynamic system responding to market realities and continuously striving for greater efficiency and fairness.
That's an interesting point about iterative refinement, and I agree that no system this complex can be perfect from the outset. However, I would frame it differently. When we talk about 99% of items previously in the 12% slab now moving to 5%, and a staggering 90% of items from the 28% slab moving to 18%, this isn't merely iterative refinement or tweaking a few knobs. This suggests fundamental misjudgments in the original classification and rate structure. We're talking about a significant overhaul of core components, not just minor adjustments. The rocky start you acknowledge and the frantic compliance efforts by businesses, many of whom faced genuine distress and even closure, were not simply teething troubles. They were symptoms of a system that wasn't fully optimized from its inception, or perhaps even adequately tested for its real-world impact on various sectors. To suggest this is merely natural evolution risks overlooking the sheer scale of these adjustments, which are in fact directly addressing issues that critics highlighted years ago, almost as soon as the system was launched. Doesn't the sheer magnitude of these changes after 8 years point to a more foundational correction than a mere progression?
I think it points to the system's capacity for fundamental correction as part of its progression. But let's shift our focus to the tangible benefits that these reforms bring to millions, because that's where the real impact is felt. The common person is a clear winner here. Think about daily consumables. Items like namkeen, bhujia, sauces, instant noodles, coffee, ghee, butter, chocolates, and dry fruits now attract only 5% GST, down from 12% or even 18%. This is a direct saving in household budgets. Even more significantly, essentials like UHT milk, paneer, chena, and all Indian breads, roti, chapati, paratha, go entirely tax-free. This isn't just a minor adjustment, it's a profound boost to affordability for staple foods. For healthcare, all individual life and health insurance policies are now GST-free, making essential protection more accessible. Life-saving drugs, cancer medicines, and critical medical equipment like thermometers move to 5% or nil. Farmers and MSMEs also celebrate substantial cuts on agricultural machinery and fertilizers, reducing their input costs and boosting productivity. Experts at SBI, for instance, predict a 60 to 75 basis points drop in retail inflation, directly translating to more purchasing power for consumers. This inflation drop, in turn, is expected to spur a 0.2 to 0.3% GDP growth in 2025-26 as lower prices stimulate demand and production across the economy. These aren't just statistics. These are deep, meaningful changes impacting daily life and the national economic trajectory.
Those are indeed compelling arguments, and I wholeheartedly agree that these tangible benefits for the common person are profoundly welcome. However, it's crucial that we consider the full picture, acknowledging the journey that led us here. We cannot forget the initial high compliance burdens and the significant difficulties small businesses, especially MSMEs, face due to the original complexities. Many small shopkeepers or local manufacturers, often with limited digital literacy or access to resources, struggled immensely to adapt to the new digital filing requirements, maintain records, and understand the intricate rate structure. This led to lost business, increased operational costs, and in some cases, even business closures, which had a very real human cost.
The game-changer narrative for GDP growth, while optimistic, needs careful scrutiny. How certain are these projections, really?
While lower GST rates can stimulate demand, the overall economic growth is influenced by a complex interplay of other factors: global economic conditions, interest rates, agricultural output, and broader investment climates. Could unforeseen impacts on specific sectors or even shifts in consumer behavior not directly linked to tax rates temper these predictions? More fundamentally, the fiscal capacity of states remains a pressing concern, particularly with the compensation cess ending by March 2026. While some consumption-heavy states, like Bihar, might indeed benefit from increased demand and higher tax revenues, debt-burdened states like Punjab or Jharkhand, which historically relied heavily on the compensation cess to cover revenue shortfalls, could face considerable strain without adequate buffers. This could lead to difficult choices, potentially impacting public services or infrastructure projects. The system's evolution must address these potential imbalances and the lingering anxieties of states, not just celebrate broad-stroke reductions that may have uneven impacts.
I'm not convinced that the ongoing concerns, while valid, undermine the fundamental strength and collaborative nature of this evolution. Consider the very mechanism for these changes: the unanimity of the 56th GST Council meeting. This wasn't some quick rubber stamping. It was a marathon session lasting over 10 hours, with finance ministers from all 31 states and union territories present and participating. This directly refutes any claims of the council being a mere formality or simply reacting to a predetermined agenda. My understanding from those involved is that the process demonstrated fierce debate, with various states presenting their specific concerns and advocating for their regional interests. This often culminated in intense negotiation and ultimately consensus, with states like Punjab and Bengal actively participating and even mediating between different viewpoints to find common ground. This isn't about a hidden agenda or central government diktats. It's a powerful testament to the robust federal structure and commitment to collaborative governance inherent in the GST's very design. It ensures diverse regional interests are represented, debated, and ultimately reconciled within a national framework. The outcome, the sweeping rationalization, is a product of this shared commitment to progress.
Right. While the vote at the council meeting was indeed unanimous, intellectual charity demands we look deeper than simply the final show of hands. Unanimity in a complex federal body doesn't automatically equate to complete satisfaction from all parties, or the absence of underlying concerns that were perhaps sidelined for the sake of consensus. We've heard opposition leaders like Kharge publicly demanding specific, robust compensation mechanisms for states, indicating that despite a unanimous vote, the fiscal anxieties of some members remain. Furthermore, let's revisit the Prime Minister's public hint at these next-generation reforms on Independence Day, August 15, 2025. While such statements might be intended to signal future policy directions, they could also be interpreted as influencing the agenda or even setting an expectation for the Council's outcome, rather than allowing for entirely organic, unencumbered deliberation among state representatives.
Among some members, despite their eventual vote, suggests that the path to consensus might still involve compromises that don't fully resolve all concerns. This hints at a system that still needs to genuinely empower its constituent states, ensuring their long-term fiscal stability is not simply a footnote, but a core consideration in future iterations.
Well, this discussion has certainly highlighted that the 2025 GST reforms represent a significant and strategic advancement in India's economic framework. They undeniably reflect persistent, collaborative efforts to refine a complex yet ultimately beneficial tax system. The deliberate focus on reducing slabs, simplifying compliance, and providing targeted relief is a clear demonstration of the system's adaptive design and the enduring power of collaborative federalism to deliver tangible, meaningful change for a vast and diverse nation.
And while the positive impact of these recent changes are clear and certainly welcome for many, they also serve as a crucial reminder of the significant initial hurdles and complexities encountered during GST's original implementation. Acknowledging these historical challenges, including the burdens on small businesses and the ongoing fiscal anxieties of states, is essential for a truly comprehensive understanding. It ensures that as the system continues its evolution, the legitimate concerns of all stakeholders, particularly regarding the fiscal autonomy and stability of individual states, are genuinely addressed in future iterations, fostering a more equitable and robust economic landscape. Our exchange today truly underscores the multifaceted nature of large-scale economic reforms like India's GST.
Ongoing need for careful consideration of their deep impact on every segment of society. There is indeed much more to explore within this monumental and evolving shift in India's economic landscape.